Hi everyone, JJ here with the Art of Value. Welcome. Well, today I want to look at some recent writing by legendary investor Howard Marks. It's called Taking the Temperature. He's talking about taking the temperature of the stock market at any one time. He looks at how he's got some market calls right from 2022 to how he's got market calls right over the years from 2000 to 2020. He made 5 market calls and got them right. And he explains how he got them right and how we can do that too in the future. So let's get into it. Mark said when he was working on his book in 2017, Mastering the Market Cycle, which is a really good book, by the way. I'll put a link to that in the description. He was talking to his son about it, and he said that, I think that all the market calls I've made over the years have been right. He was quite astonished by that. And his son said, well, yeah, Dad, that's because you've only made 5 calls in 50 years. And Mark's thought about it and he said that was absolutely correct. He'd only made 5 calls in about 50 years on which way the market was going to go. So he decided to go back through the memos that he writes, the famous Howard Marks memo, to see what he was thinking at the time that he made these calls, why he was correct about them, what led him to be correct about these 5 calls that he made about turning points in the market. First, he talks about the dot-com bust in 2000, and he said in 1999 he read a really good book called Devil Take the Hindmost by Edward Chancellor, another really good book. I'll put that in the description as well. I read that actually leading up to 2020, the crash of 2020. I read that book. It's an excellent book. I've read it a couple of times. And so he said he read that book, and in the book he was struck by how similar it was to that time period, 1999, during the dot-com bubble. So a lot of people couldn't see that it was a bubble. Howard Marks did see that it was a bubble, and he felt that a lot of things in that book about bubbles over the centuries were similar to what he was seeing in the market at that time. What he saw at the time in the market that's laid out in that book with bubbles throughout history is the willingness of people to leave their day jobs to chase easy profits in the market, putting money into investments that were speculative, that companies that had no profits, and that stocks could only go up, the market could only go up. A feeling of extreme optimism, and that's what he saw at the time in 1999. He saw people investing in companies with business models that couldn't be explained, and he said these things rhymed with bubbles throughout history. They weren't exactly the same. It's never exactly the same, but it definitely rhymed. And he laid it out in a memo at the time called Bubble.com, just as 2000 began in January 2000, and the bust did not come very long after that at all. An irrationally elevated opinion of an asset or sector is how he defines a bubble, and that's exactly what he saw in the late 90s, especially 1999 leading up to the bust. He said people were investing at multiples of revenue, and some of these companies didn't even have revenue, and the business models were very questionable, hadn't been proven at all. So he wrote in that memo that that was the case and that he saw a bust coming. In that memo, he wrote, "In short, I find the evidence of an overheated speculative market in technology, internet, and communication stocks overwhelming, as are the similarities to past manias." He said the reason that the bubble burst back then was for no other reason that the stocks became unsustainably high. There was no real trigger to burst it, so it's very hard to predict when these things will burst. So the S&P 500 dropped 46% from its 2000 high, and the Nasdaq dropped 80% from its high, and it took a couple of years to do it. A lengthy bear market there from the peak of that bubble. Next, he turns to the period 2004 to 2007 after that bubble, and he refers to that as a slow developing train wreck as he saw it. Here he says that he was a bit too soon in calling this out. He says that the Fed was being very accommodative, lowering interest rates, lowering rates to get through this dot-com bubble bust earlier, but they were being too accommodating and it was leading to bad things in that environment. In 2004, he observed and wrote that he thought that the prospective returns on many assets were unusually low, had become unusually low, and that investors he saw were taking unusually high risks and looking at alternative investments, risky investments. In 2005, he discussed some of those alternatives, including residential real estate, and he observed that investors were taking unusual risks and embracing the fallacy that house prices only go up. At the time, he saw some crazy deals being done, and he said that they agreed at the time in their firm that if deals like this could be done, then there was something wrong with the market. He said he didn't know exactly what was wrong with it, where the problem was, but he knew there was a problem with the market. Because of the problems they saw in the market, they decided to move to more a defensive stance in their funds. They sold some assets, liquidated some things in readiness for what they thought might be coming, didn't know what exactly what, but they just saw that the temperature was too hot and they needed to be more defensive. In 2007, he wrote another memo called It's All Good, and of course it wasn't. He observed that it had become even riskier and the prospective returns on investments had become pretty low. He saw lots of risks being taken by investors in the market, and it was a bit of a warning, and he was pretty much dead on this time in 2007. And of course, things hit the fan in 2008. He said it was 8 months after that Bear Stearns melted down and Lehman Brothers went under and Morgan Stanley, Merrill Lynch. Merrill Lynch was rescued by Bank of America. It was a chain reaction after that, 8 months after he wrote that memo about the dangers of what he saw in the environment at the time. It wasn't a stock market bubble, of course, this time, but it did affect the stock market. The S&P 500 dropped 53% from its 2007 high, so it really did impact the stock market and the whole economy this time. There was a lot of impact. He said his company had no assets in subprime at the time, but these subprime so-called assets did affect the whole economic system, as we all know. So he says he really didn't know the source of the problem that was about to happen, but he said it's a good example of what he calls taking the temperature of the market. He took the temperature of the market, saw that it was hot, saw that there were problems, didn't know exactly what they were, and decided to be more defensive, and then wait and look what happened. Now, if you're getting value out of this episode so far, do think about subscribing if you're not already to get more of this kind of investing content in the future. Also, thanks to those people on Spotify. I just realized that the show has got a 4.9 star rating. I hadn't looked at that before. I hadn't asked people to rate it. So thank you to those people who have done that. When things fell apart in 2008, things really fell apart. Things were very pessimistic, very bleak. There was talk of the whole economic system collapsing. He thought at that time that they had to decide if there were buying opportunities out there, what they would do. Very difficult to do at the time. They took the opinion that things would probably get better in terms of probabilities, and if it did one day get better, companies would still make money, and these would be some really good buying opportunities, even if it wasn't the bottom yet. And that's exactly what they did. They put money to work. They put a huge amount of money to work from September 2008, a very bleak period, and that turned out in the long run to be correct, but very hard to do. Not many people were doing that, and it worked out very well. He said he didn't know where the bottom of the market was. It was impossible to know, and as value investors say, it's better to invest on the way down and just keep investing more if you can as it goes down, because you never know where the bottom is. So if things are very bleak and pessimistic, that's a good time to invest, and that turned out to be correct in this case. So again, he said he was just taking the temperature of the market, so he wasn't predicting anything. He didn't know what would happen. He was just taking the temperature, and he said it was very cold at that time and saw a buying opportunity because of that. It was such a contrast from being a very hot market. They had no idea how low it would go, but it turned out to be that good buying opportunity because the market was so cold and so pessimistic. The next time period Marx talks about is 2012. He makes the point that stocks didn't really go anywhere all the way from 2000, the Dotcom Bubble, to 2011. The market, the S&P 500, returned about 0.5% through all that time. So people did get disillusioned who were involved in the dot-com bubble. They were kind of not interested in the stock market. And then the great financial crisis happened not long after that, really. So people were really not interested in the stock market for that long period of time where it did not go anywhere. He talks about the temperature of the market back then being pretty low. He talked about this article, The Death of Equities, which came out in 1979. And he saw parallels to that time in 1979 where the stock market had really gone nowhere for a long time. During the 70s, it was not great, and he saw 2011, 2012 being this period. He thought that there was a lot of pessimism around. People had given up on equities, and this article called out the death of equities, that wasn't going to go anywhere for a long time still, and there was a lot of pessimism around. It was kind of like the nail in the coffin. That's it, the stock market's over. And soon after that, it had an incredible run. After 1979, all through the 80s, it really had a great run leading up to the dot-com bubble. So all through the 90s as well, all through the 80s and 90s, stock market did very well. And he saw this parallel with the feeling of the environment, the temperature of the market at that time, and he thought that that might be a good time to invest. And indeed, it was a bull market from then leading up to 2020. If you think of the stock market from 2012 to 2020, it had very good returns. It's when so-called growth investors did very well, growth companies. It was a long bull run after this very stagnant period where it went nowhere. So his memo at the time was called Déjà Vu all over again, where he made parallels to that time when this article came out and people thought the stock market was continuing to be stagnant, was going to continue like that for a long time. Nobody saw any upside to the stock market. People had lost interest and lost hope in the stock market ever going up again, and he saw parallels in this time. And so he was taking the temperature of the market, thinking there's a good chance, a good probability that stocks will do quite well over the coming period, not being stagnant at all. From 2012 to 2021, the S&P 500 returned 16.5% a year, which is a really good run. And he makes the point that negative sentiment in the market resulted in superior gains over the next time. So being contrarian is what's needed at a time with negative sentiment or overly optimistic sentiment as well. Both of those things, but not being just contrarian for not being contrarian for contrarian's sake all the time, but picking the times, these times that he picked in the market, and when there's a negative sentiment or a positive sentiment to the extreme, that's the time to think about being contrarian. The last of his 5 calls was in March 2020. Of course, that was the pandemic. We all remember what happened. We've all lived through that. And in February 2020, by that time the news was out, this pandemic was happening, and the market panicked. In the space of 1 month from mid-February 2020 to March, the market dropped by almost a third, the US market that is, and other markets around the world. There was total panic, and that was a very fast fall in historical terms. Again, people didn't know what was going to happen, and then the economy was shutting down. It was panic and fear all around, and the market dropped by a third, so a lot of people sold. So again, he makes the point of taking the temperature of the market. Suddenly things were very pessimistic. People thought that the whole system would collapse, the economy was shutting down, and he took the attitude that he didn't know where the bottom was. There was no way of knowing, and he thought that it would be a good idea to invest on the way down, seeing the market had dropped so much in a short time. He didn't know where the bottom was. Nobody did, but they say it's better to invest on the way down because you don't know that. You don't know where it's going to go, and there's a good chance, a good probability that it would turn up eventually over the long term. So in hindsight, it was a good time to invest, and he said he thought that at the time. He said so, that this is the probability that this is a good time to buy, not to sell in panic. He also makes the point that it wasn't easy to be contrarian at the time when everybody was panicking, but rather than have paralysis, either selling or sitting pat, to go in and buy. Very difficult, because it was one of the most challenging times that he's ever invested through. Again, we can all remember the fear around what was going on there. In terms of buying at that time, it was a difficult time to go in and buy, especially when things went down so fast. It caught a lot of people by surprise, but he was saying that to keep your head in those times and to go in and buy is a contrarian thing to do, and very difficult, but that's what good investors must do. He talks about how we can all make these right market calls the way that he has. Part of what he said is that he only made 5 of them over that long, since 2000, which is not very many. He said he could have made market calls all the time. As you see in financial media, people make calls about where the market's going week to week, day to day even. He said he could have made 50 calls. He could have made 500 calls over that time, but he only made 5. And it was when the market was very extreme, either to the upside or downside. The pessimism, market psychology was extreme to one side or the other, or there'd been that long period of stagnation and that had caused a lot of pessimism. So it's about probabilities, taking the temperature of the market, and only when it's at an extreme can you kind of make that call. That's what he's saying. That's why he says everybody can do it. So it's about history rhyming, learning from history, seeing these bubbles and busts and extremes, and learning from that the probability of the similar thing happening again, the similarities to the past. He said that he made these calls from 2000, but he was actually investing for 30 years before that. So it took him 30 years to kind of start making these correct calls. It took him experience of seeing the history of the market, seeing what happens in these extreme situations before that, and being able to make these calls. And as he said, not making them all the time, only making them on these rare occasions. He emphasizes that this is not about making macroeconomic predictions. It's about taking the temperature of the market. It is about seeing the economic environment at the time, taking the temperature of that, not predicting what's going to happen next. It's not about that. It's not about knowing that. He is a fundamental investor, looks at fundamentals rather than the macroeconomic situation. Say someone like Stanley Druckenmiller, who makes calls all the time, even from week to week, and changes his mind. Very few people can do that, but I think we could agree that a lot of people could take the temperature like this. We could see the extremes of the dot-com bubble, of what happened in 2020 when the market crashed, and indeed after that in 2021 and 2020 when there was so much stimulus and there was a lot of speculation around, so much speculation. If you think of the SPACs and the price multiples that some companies were trading at huge multiples to revenue, let alone profits, and that led to a bubble, I think, at the time. So he talks about pattern recognition in the market being important, seeing these extremes over time, the highs and lows, and the investor sentiment, the market cycles, mastering the market cycle. His book talks about it in there. He talks about all of this stuff in there, a lot of this stuff, and Devil Take the Hindmost, studying the bubbles in history. I found that very instructive. In 2021, after the crash happened in 2020, I did see a lot of speculation. I was reading that book at the time before that all happened, and I did see some rhyming and similarities with some of those great bubbles in the past, with these speculative innovation stocks that had no profits, little revenue, that went to the moon. There was stonks only go up. There were a lot of new investors in the market, a lot of speculation in NFTs and SPACs, so many things. There was a lot of rhyming going on there, I thought too. I think this is a really instructive memo from Howard Marks this time about taking the temperature of the market at any one time. We've seen quite a lot in the stock market over the last few years. We've seen highs and lows, extreme optimism and extreme pessimism, as he's talked about here. So it'll be interesting to see what happens over the next decade. We're long-term investors, so are we going to see any of these extremes again in the market? We can see some in the AI bubble, which I think is a bubble, is extreme optimism in that particular area, but in other areas not so much. So it's going to be interesting over the next few years to see what happens if taking the temperature of the market. Now, about 6 months ago, I made an episode about what Howard Marks was saying about a historic sea change happening in the market. He sticks by that. I'm going to put that there if you're on YouTube, or in the description, or if you're elsewhere. Go and see that now. It's interesting to see what he said back then. And thanks for watching or listening this time, and I'll see you in the next one.